Are you thinking about getting a reverse mortgage? Or do you just want to see what they are about? You've come to the right place. I believe in education. I think the more people know, the better decisions they'll make. A reverse mortgage may be a good option for you, and it may not. But at least by watching this presentation, you'll have the correct information to make that choice. I'm going to be talking about how a reverse mortgage works and who qualifies. I will show you real numbers so that you can see the costs involved. You'll see how a reverse mortgage line of credit grows over time, allowing you to access even more proceeds down the road. We'll discuss the payout options and what happens when the loan becomes due. And we'll debunk some of the many myths that are out there. In short, you will learn pretty much everything you need to know about reverse mortgages so that you can decide whether it might be a good option for you. Now, if you're retired or considering retirement, there are three important questions to ask yourself. Will I have enough money to meet my basic living needs? People are living longer, which is a good thing, but you may not have planned for such a long retirement. And as you may have noticed, the cost of everything is going up. Will I have enough money to maintain my standard of living? I live in a 55 plus community, and I play pickleball with 80 and even 90-year-olds, and it's really inspiring. People are so much more active than my grandparents' generation, and they're not just sitting home every night watching Lawrence Welk, which is what I remember. They're traveling, they're going out, they're living full lives, and they want to continue that lifestyle, and I don't blame them. Will I have access to tax-advantaged money when I need it? The funds from a reverse mortgage are considered loan proceeds and are therefore tax-free. So sometimes it makes more sense to tap into your home equity rather than liquidate retirement accounts and pay the taxes that go along with that. That's especially true if we're in a down market where you really don't want to be cashing out those investments. There are a few ways to access your home equity. There's the cash out refinance, which is essentially getting a new mortgage. There's the home equity loan, which could be a second mortgage, but then you're going to have two loans and two monthly payments. Or you can get a home equity line of credit, which we call a HELOC. And with those first three options, you're going to need qualifying income, a decent FICO score, and you would have monthly mortgage payments. You can sell the home, but you're still going to need to find another place to live. And what if you don't want to sell your home? Well, a reverse mortgage is for people who want to stay in their home. They want to age in place. And with the reverse mortgage, there are no required monthly mortgage payments and minimal requirements to qualify. People don't often realize that their home has generated significant equity, and a reverse mortgage can convert that equity into much needed cash. A reverse mortgage, also called a home equity conversion mortgage, is a special type of loan insured by the FHA that enables homeowners age 62 or older to access the equity in their home without having to sell the home, give up title, or make monthly mortgage payments. And I am specifically talking about the FHA insured home equity conversion mortgage, or what we call a HECM. There are other non-FHA reverse mortgages offered by private lenders, and they do have their own purposes. But 90% of all reverse mortgages are the FHA HECM, and that is specifically what I'm talking about here. Now, I just mentioned the home equity line of credit, and they are usually compared to reverse mortgages as an alternative because they are both tapping into your home equity. So I want to show you a quick comparison between the two. Now, HELOCs can be very useful, particularly if you are still working and you expect your income to increase. But I want to show you why they are not always the best fit, especially if you're on a fixed income. With a reverse mortgage, you keep the title to the home. Well, this is also true with a HELOC, but as you will see, that's where the similarities end. With a reverse mortgage, no monthly mortgage payment is required. That's not true with a HELOC. With a reverse mortgage, your line of credit is protected from being frozen by the lender. Now, if you had a HELOC in 2008 during the financial crisis, chances are it was frozen or canceled. With a reverse mortgage, your line of credit grows, and I will get into how that works in a minute. But it is the only line of credit on the market that has this growth feature, and I think it's one of the most impressive aspects of a reverse mortgage. You can draw from a reverse mortgage for the life of the loan. With a HELOC, the draw period typically lasts 5 to 10 years, and for that period, you only pay interest on what you borrow. But after that, not only does the draw period end and you cannot take out any more money, but now your payments have increased because you now have to pay back both principal and interest. And here you are, 5 to 10 years older, when maybe your income doesn't go as far as it once did. And guess what? If you miss a few of those payments, you can lose your home. Now, one of the misconceptions is that reverse mortgages are risky. What's risky is having a traditional mortgage or HELOC, where you are one financial crisis away from missing a few payments and facing foreclosure. With a reverse mortgage, you don't have that risk because there are no required monthly mortgage payments, and you can stay in that home for life regardless of market conditions or how high the loan balance is. And the reason you can draw on that line of credit with no time restrictions and no risk of it being canceled is because reverse mortgages are insured by the Federal Housing Administration. And reverse mortgages are non-recourse loans, which means the house stands for the debt, and neither you nor your heirs are personally liable for any outstanding debt above the value of the home. That is not the case with other mortgages or HELOCs. And this is another FHA protection. So I want to give you a little background onto how these loans came to be. The first reverse mortgage was written in 1961 by a small bank in Maine to help the wife of a high school football coach stay in her home after her husband passed away. Well, by the 1980s, the federal government saw the benefits of reverse mortgages and how they could help seniors get access to their home equity while still living in and owning their home. And it makes sense if you think about it. For most people, their home is their largest asset. So there should be a way to tap into some of that equity that they've built up without the income requirements necessary for a traditional loan or the need to make monthly payments. So in 1988, President Reagan signed a bill that made reverse mortgages government-insured loans under the FHA. And over the years, there have been many changes and protections that have been added to make these loans safer and more viable. So who is eligible? Well, you must be 62 or older. You must either own your home outright, or if you have a mortgage, you must have a considerable amount of equity, generally at least 40 to 60%. The home must be your primary residence, which basically means that it's where you live for the majority of the year. And if you're away because of a medical situation and you need long-term care, you can be out of the home for up to 12 months. The income requirements are minimal and there is no minimum FICO score, but you must pass a financial assessment, which demonstrates the ability and capacity to pay your property taxes, homeowners insurance, HOA fees if you have them, and other home-related expenses. But it's much easier to qualify for a reverse mortgage than a traditional loan. The FHA requires that you meet with a HUD-approved counselor. They just want to make sure that you understand how the loan works and your obligations. Now, you will hear me mention these several times over the course of this presentation because it is important that you know them. Because if you keep up with these obligations, the FHA guarantees that you can stay in your home for life. So what are your obligations? Well, you must occupy the home as your primary residence. And how do they know this? Well, the servicer will be sending out an occupancy certificate every year, and you must complete it and return it every year. You must remain current on your property taxes, your homeowner's insurance, and any HOA fees. Now, with the reverse mortgage, you will not have a required monthly mortgage payment. However, you must keep up with these ownership costs. And you must maintain the property. Now, this doesn't mean that they're going to send inspectors to your home to make sure you vacuum that week. But if your homeowner's insurance gets dropped because your home is in disrepair, or you start getting notices from the county, well, that would be an issue. Now, with a reverse mortgage, they don't kick you out of your house if you use up all your equity or you become a certain age. So considering you get to stay in your home for life while tapping into your equity with no required monthly mortgage payments, these obligations are pretty minimal. I mean, we all have to pay property taxes and HOA fees if you have them, and most of us already carry homeowners insurance. So the biggest question everybody has is, how much can I get? Well, the benefits are determined by the age of the youngest borrower. Basically, the older you are, the more you can get. It's like Social Security in that respect. It's also based on the appraised value of the home and the current expected interest rate. And these calculations are determined by the FHA. Now, you have multiple payout options. You can take your funds in a lump sum. Now, a reverse mortgage has to pay off any current mortgages. It must be the first position lien. But for many people, just freeing up that monthly mortgage payment can have a significant impact on their cash flow. Now, any funds left over from paying off your mortgage, or if you have no mortgage at all, you can select fixed monthly payments over a set term or for life. You can leave the proceeds in a line of credit that's going to grow, and you can draw on it at any time. Or you can do a combination of all three, and these can be changed at any time. Now, most people opt to take some cash out at closing, maybe to pay off some bills, to travel, or to do some renovations, and then they leave the rest in that line of credit that's going to grow for future needs. And I'm going to show you how that works. Now, this is for illustration purposes only, and it is not a quote. But I want to give you an idea of how a reverse mortgage line of credit grows at the same rate as your loan balance. Now, this is an amortization table based on a 75-year-old with a home value of $400,000. They did not have a mortgage to pay off, and they did not take out any cash at closing. Now, this is an adjustable rate product, and it's 6.5% in this scenario. There is a fixed rate reverse mortgage, but 95% of FHA reverse mortgages are the adjustable rate. Unless you want the entire sum at closing, they just don't make a lot of sense in this market. And the adjustable rate offers more proceeds, has a lower rate, and it has this line of credit. The total loan proceeds in this particular scenario are a little over $170,000. And that is the line of credit plus, let me get my pointer out here. That's the line of credit plus the loan balance. The loan balance consists of the closing costs, which are typical for any loan transaction. And they are your settlement fees, your recording fees, your title fees, origination fees, etc. And these costs, again, are in line with a traditional mortgage, around $8,400 in this scenario. And because these are government insured loans, there is a mandatory FHA insurance, which is 2% of the home value, which is $8,000 in this case. So those two costs combined make up the starting loan balance. Now, the column on the right is the net equity, which is the home value minus the loan balance. Now, this is 5 years later, and it's assuming the interest rate has not changed and the line of credit has not been used. You can see the home value has risen to over $486,000. The FHA uses a 4% appreciation rate. California has typically, not typically, but historically, been closer to 6%. But we use the FHA's rate for these calculations. But if you look at the line of credit, it is almost $63,000 higher. So you can see that just by letting these proceeds sit there, the value is going to grow. Now, the FHA does this so that these loans can grow along with the home value. They don't want you to have to refinance every few years as your home increases in value. And that's another FHA protection. The loan balance has also grown. They are both growing at 6.5% in this scenario. The line of credit has grown at 6.5%, and the loan balance has grown at 6.5%. Now, if the home was sold at this point for the estimated $486,000, the loan balance of $23,225 would be paid off, and the homeowner or the estate would keep the $463,000 proceeds. So you only ever owe what the loan balance is, just like any other loan. Again, we are assuming that the rate hasn't changed, but in 10 years at this rate of 6.5%, the line of credit has pretty much doubled. Now, of course, if you take money out of the line of credit or you start getting payments, it will come off the line of credit and it will get added to the loan balance. For instance, if you take out $100,000, your line of credit would then be $205,497, and it would continue to grow from there. And your loan balance would be $132,720, and it would continue to grow from there. And as you may have surmised, if the rate goes up, your line of credit will grow faster, as will your loan balance, and vice versa, because again, they are growing at the same rate. And as you can see, even if you don't use the money now, but you want that line of credit there for the future, it can be advantageous to put a reverse mortgage in place early so that this line of credit has a chance to grow. Now, this is obviously a situation where the borrower did not use any of the proceeds, just to show you how this line of credit grows. But here we are 20 years down the road, and you can see that the available proceeds, the line of credit, is increasing along with the home value. The loan balance and the net equity have also increased. Now, some people say, I don't need a reverse mortgage. My house is paid off. And that's great. I mean, it is a wonderful accomplishment to have paid off your mortgage, no doubt. But that's your money that's trapped in your home. And if you want to have access to it, this is a powerful tool for that. And for many people, it's a small price to pay to have a growing pool of money that you can access at any time for as long as you're in that home. And again, interest on a reverse mortgage loan balance only accrues on the money you use. So that line of credit is just your equity that you can tap into or not. And just to point out, in this particular situation, if this person decided to buy a $606,000 boat or something at age 95 and use up this entire line of credit, that $606,000 would get added to this $64,000 loan balance. So it would make the loan balance around $671,000. But if you notice, their home is worth $876,000. So even using up this entire line of credit at this point, they would still have around $200,000 in equity in this scenario. So a reverse mortgage doesn't necessarily use up all the equity. There are many cases where there is still equity left over. It doesn't always happen. It can use up all your equity, but it's not always the case. It's not a given. And of course, if this home was sold at this point, it would be sold for $876,000. The loan balance of $64,944 would be paid off, and the proceeds to the homeowner or their estate would be $811,505. Just like any other loan, you just pay off the loan balance. So what are the benefits of a reverse mortgage? Well, they are government insured. If something happens to the market or to the lender, your funds are guaranteed. The line of credit is guaranteed, and it grows over time, as I just demonstrated in that chart. The funds are non-taxed. Now, we say to consult a tax specialist because I am not one. However, the funds themselves are not taxable income. But if you invest them, you could be liable for proceeds from the investment. You could use the funds however you choose. There are no restrictions. And it is a non-recourse loan. The home stands for the debt. And when the loan becomes due, neither the homeowner nor their heirs will owe more than the home's value. And any remaining equity beyond the loan balance belongs to the estate, just like any other loan. There are minimal income requirements, no credit score requirements, no loss of ownership rights, no prepayment penalties, no required monthly mortgage payments, and you never have to move out of your home. They can be used to eliminate a monthly mortgage payment, provide a line of credit for future financial needs, to purchase a home without spending all of your cash. And I will explain really quickly how that works. Say you want to downsize, you want to purchase a home for $400,000, but you don't want a monthly mortgage payment. So instead of putting $400,000 into the new house, you can purchase it with a reverse mortgage. Now, like I said, you need 40 to 60% equity. So that would be your down payment. So let's say you put down $200,000 instead of the $400,000. The reverse mortgage will cover the rest, and it leaves you with that extra $200,000 cash in your pocket. And you get all the protections of a reverse mortgage, including being able to stay in that home for life with no monthly mortgage payments. Now, this is becoming pretty popular because you're essentially able to buy more house with less cash. They can also be used to consolidate debt or to pay off other debt, to supplement your monthly income, for retirement, as a retirement planning tool, for remodeling, home repair, or maintenance, for healthcare costs, for long-term or in-home care, to create a cash reserve for emergencies, or funds for travel and recreation. I mean, again, it's your money and there are no restrictions. Now, people don't realize, but you can make payments if you'd like. You have the option to pay as much or as little of the loan balance as you want, or you can make no monthly mortgage payments at all. If you do make payments, they will come off of the loan balance that you owe, and they will get added to your line of credit, which is growing, but payments are never required. And as long as you meet your loan obligations, those 5 things, it's your primary residence, you maintain the home, you pay your property taxes, homeowners insurance, and HOA fees, the FHA guarantees that no repayment of the loan is required until the last borrower moves out or passes away. When the loan becomes due, you or your estate have up to 12 months to repay the loan balance. And this is typically achieved by selling the home. And any remaining proceeds would be theirs to keep. Now, if the loan balance is more than the value of the home and they want to keep the home, they don't have to pay back the entire loan balance. They can buy the home back at 95% market value. Or if they don't want the home, they could simply walk away and the FHA insurance will cover the shortfall to the lender. Now, because they are insured by the FHA, the HECM is one of the safest and most regulated mortgage products available. Many of the most significant safeguards came in the last 10 or 20 years. Again, they are non-recourse loans. The homeowner retains title to the home as long as the loan terms are satisfied. The homeowner or estate is entitled to any remaining equity after the loan balance is paid. There is mandatory third-party counseling so that you understand how these loans work. There are non-borrowing spouse protections, which means if your spouse is not 62 when you take out the loan and is therefore not a borrower on the loan, that younger spouse can still remain in the home for life, even if something happens to you. You used to hear those stories about the little old lady being kicked out of her home because it had a reverse mortgage and her husband passed away. Well, the only way she is getting kicked out now is if she doesn't uphold the loan obligations. Those 5 things: occupy the home as your primary residence, pay your property taxes, homeowners insurance, and HOA fees, and maintain the property. Your line of credit cannot be canceled, frozen, or reduced, and it grows regardless of the home value or market conditions. If they put a nuclear power plant across the street from your house and your home value declines significantly, that line of credit does not care. It is still going to grow, and it's going to grow at whatever the rate is. And in 2015, they started requiring a financial assessment just to make sure that you can keep up with your loan obligations and thus stay in your home. So what is the process? Well, first, I would obtain your basic information, just your date of birth, address, estimated home value, and the amount of any mortgages on your property. And just with that information, I can determine whether you have enough equity and how much you would qualify for. We would not need to run credit or anything else at that point. After that, you would attend the mandatory HUD counseling. Now, counseling is required for all homeowners on title, and anyone you want involved in this decision, such as adult children, can participate in the counseling. I think it's better to get them involved in this process early if you want them involved. That is entirely your decision. But I've seen the parents research these loans and decide it's a good decision for them, only for an adult child to hear about it at the last minute and want to put a stop to it because they think their parents are getting scammed or they think the bank is taking the home. So if you have others that will be involved in this decision, or if you just want them to understand how it works, it's best to include them early, either through the counseling or a presentation like this. And during the counseling, they're going to make sure that you understand the loan terms and your obligations. And they're going to make sure it's a good solution for you. This usually takes about an hour, and it can be done over the phone or in person. Now, California does have a 7-day waiting period after counseling before we can order any appraisals or anything like that, because they just want to make sure that you have time to think about it and you're not making a hasty decision. I have actually had clients that have watched this presentation that have come back and told me that their HUD counselor was impressed by how much they knew about these loans. And I'm very proud of that because that means I've done my job here. After that, we would complete the loan application and gather documents. And we would also conduct a financial assessment and we would do the appraisal. Then it would be submitted for loan processing. We would close the loan and you would receive or have access to your funds. And the whole process typically takes 30 to 45 days. Generally, the only out-of-pocket costs are the counseling requirement, which is usually around $100 to $200, and the appraisal, which can be usually $600 to $800. The other costs are rolled into the loan and become part of your starting loan balance. Now, I want to go through some of the more persistent myths and misconceptions about reverse mortgages. Unfortunately, these myths often prevent seniors from even considering a reverse mortgage when it could provide exactly the type of financial assistance they need. The myth that reverse mortgages are a scam. Well, they are most definitely not a scam, and I hope I have at least shown you that today. As I said, they are insured by the Federal Housing Administration, and because they are backed by the federal government, and seniors are a protected class in this country, they are one of the most regulated loan products available. The bank owns your home. That is not true. The bank is not in the business of owning real estate, and the lender is never on title. Just like any other loan, the homeowner always remains on title and owns the home. And just like any other loan, the only thing that is owed is the loan balance. So if the home is sold, the loan balance gets paid off and the homeowner or their heirs keep the remaining profits. The myth that your Social Security or Medicare will be affected. This is false. A reverse mortgage has no effect on your Social Security or Medicare benefits. It could possibly affect your eligibility for some needs-based programs, such as supplemental security income or Medicaid, although there are workarounds for that as well. But it does not affect your Social Security or Medicare. The funds received from a reverse mortgage are taxed. This is not true. Reverse mortgage payments are considered loan proceeds, and they are not taxable. And this is one reason why some financially savvy people are turning to reverse mortgages to avoid taking taxable withdrawals from their other retirement accounts. Reverse mortgages are only for desperate homeowners or as a last resort. Although they can be a significant source of funds when they are needed, the fact is they are a powerful financial tool that can be used to pay off existing mortgages, to delay Social Security or other retirement withdrawals, or to establish an emergency line of credit, as you saw in that chart. You can be kicked out of your home if you outlive the loan. Again, this is false. You cannot be forced out of your home as long as you maintain the terms of the loan, which are pay your property taxes, your homeowner's insurance, and any HOA fees. Maintain the property and use it as your primary residence. You or your heirs can end up owing more than the home is worth. This is absolutely false. This is a non-recourse loan, which means the loan is not secured by any assets other than the home. If the proceeds from selling the home don't cover the loan amount, the FHA insurance covers the shortfall to the lender, so no debt is passed to the heirs, and they can simply walk away. And of course, if there is equity left in the home, it goes to the homeowner or the estate after the loan balance is paid. You can never get out of a reverse mortgage. This is not true. There is no minimum term and no prepayment penalties. Reverse mortgages make the most sense for people who want to stay in their home. But just like any other loan, the homeowner owns the home and can sell it at any time and just pay off the loan balance. You cannot get a reverse mortgage if you have a mortgage. Again, this is false. You can get a reverse mortgage whether you currently have a mortgage or not. You just have to have enough equity. I mean, you need equity in order to borrow from it, right? But if you have a mortgage, the reverse mortgage will pay that off, thus eliminating your monthly mortgage payment. And if you don't have a mortgage, that just means there's more cash to you to use as you wish or to leave in that line of credit to grow for future expenses. Reverse mortgages are too expensive. People tend to think that rates are really high for reverse mortgages. The fact is that interest rates and closing costs are in line with traditional mortgages. But since it is a federally insured product, there is also the mortgage insurance premium. It's like the funding fee on a VA loan or the mortgage insurance premium on FHA loans. The upfront mortgage insurance premium is 2% of the home's value, and the annual premium is 0.5% of the loan balance, and that is baked into the rate. Now, these costs are typically financed into the loan. And while this insurance may sound expensive, I think the question you have to ask is, compared to what? Withdrawing your money out of a taxable retirement account? Taking Social Security earlier than anticipated? Or having to sell your home and relocate? I mean, just selling your home can cost 8 to 10% of the home value. And of course, reverse mortgages are for seniors who want to stay in their home. They don't want to move. And this FHA insurance is what protects you and your heirs from ever owing more than the home is worth and allows you to stay in your home regardless of the loan balance or market conditions. And it's also what protects that growing line of credit from ever being frozen or canceled. So for many people, it's a small price to pay for a lifetime of peace of mind. Now, I want to do a quick recap of everything we talked about. We discussed what a reverse mortgage is and who qualifies. You must be age 62 or older with a considerable amount of equity. We discussed the borrower obligations, those 5 things, and this will be the last time I mention them, I promise. Maintain the home, use it as your primary residence, pay your property taxes, your homeowner's insurance, and any HOA fees. We talked about payout options. You can take a lump sum, monthly payments, 10-year payments. You can leave it in that line of credit, or a combination of those, which can be modified at any time. It's totally flexible. We went over the benefits It's government insured, non-taxed funds. It's a non-recourse loan. There are minimal income requirements, no loss of ownership rights, no required monthly mortgage payments, and you never have to move out of your home. We talked about what happens when the loan becomes due. Just like any other loan, the loan balance gets paid off, and you or your estate keep the remaining proceeds. If the loan balance exceeds the home value, the house can be purchased at 95% market value, or they can simply walk away, but they will not owe any outstanding balance. We went over the line of credit growth feature and how it is guaranteed to grow at the same rate as your loan balance. We discussed the numerous consumer safeguards put in place protecting borrowers and their spouses. And we went over the loan process, which besides the counseling, it's pretty similar to a regular loan, but with less financial scrutiny. And we debunked some of the numerous myths that are out there. So do you think that tapping into the equity that you have built up in your home could make a difference in your life? And that's the question, right? It's about quality of life. And this is your equity that you've worked hard for. Now, everyone's situation is different. And like any loan, a reverse mortgage may or may not be the right fit for you. But hopefully after watching this, you have a clear understanding of how a reverse mortgage works so that you can decide whether it's something worth considering. And if you would like to know if you qualify and how much you would qualify for, you are welcome to reach out to me. If you are in California, I am happy to look into your situation. I am in Southern California, but I work in the entire state. You can reach me at the number or email above. And if you have any further questions, I am here for that as well. And if you know of anyone else that could benefit from this information, please feel free to share it. Again, I want to thank you so much for watching. I appreciate your time, and I hope I answered all of your questions. Thank you.